Inflation is one of the most significant economic challenges that individuals and businesses face today. It is a measure of the rate at which prices of goods and services rise over time. Inflation can erode the purchasing power of your money, making it essential to understand its impacts on your finances. In this video, we'll be discussing the inflation outlook for 2023 and comparing it to inflation in 1943. We'll be taking a closer look at the insights provided by one of the most successful investors of all time, Warren Buffett. Buffett has been able to consistently generate impressive returns by making smart investment decisions, and his views on inflation can provide valuable guidance for investors. In the first part of the video, we'll discuss the basics of inflation and why it's important to monitor its impact on the economy. Then, we'll explore Warren Buffett's insights on inflation and his views on how it compares to 1943. We'll conclude the video by sharing actionable advice on how investors can protect their portfolios from the potential effects of inflation in 2023. So let's dive in. What is inflation? Inflation is a sustained increase in the overall price level of goods and services in an economy over time. It is typically measured by the Consumer Price Index, CPI, and is expressed as a percentage increase over a specific period. For example, if the CPI of a country increases from 100 to 110 over a year, the inflation rate is 10%. Inflation is influenced by a variety of factors, including monetary policy set by commercial banks, supply and demand dynamics in the market, and international trade. When the supply of money in circulation increases faster than the production of goods and services, prices tend to rise, leading to inflation. Similarly, when demand for goods and services outstrips supply, prices rise, causing inflation. In addition, inflation can be impacted by global events such as wars, natural disasters, and pandemics. Inflation has been a common occurrence throughout history, with examples ranging from the hyperinflation of the Weimar Republic in the 1920s to the stagflation of the 1970s in the United States. The impact of inflation on the economy can vary, but generally, it erodes the value of savings, reducing purchasing power, and can lead to economic instability. Warren Buffett's warning about the potential for high inflation in 2023 has drawn attention to the similarities between the current economic climate and that of the United States during World War II. Buffett has noted that the influence seen in 1943 is comparable to what we might see in 2023 due to similar economic factors and government policies. To provide context for Buffett's warning, it is important to understand the current state of the global economy. The COVID-19 pandemic has led to unprecedented government stimulus and central bank interventions, which has injected trillions of dollars into the economy. This influx of money has led to concerns about inflation, as the supply of money has increased faster than the supply of goods and services. Additionally, the pandemic has disrupted global supply chains, causing shortages of goods and contributing to rising prices. These disruptions have been compounded by trade tensions between major economies, which could lead to further inflationary pressures. Overall, the combination of government stimulus, supply chain distributions, and trade tensions has created a volatile economic environment. That could lead to inflation reminiscent of that seen during World War II. Inflation affects different types of investments in various ways. Stocks, for instance, may be positively impacted by inflation, as companies may experience higher revenues and profits. However, inflation can also lead to rising interest rates, which can negatively impact stocks. Bonds, on the other hand, are typically negatively impacted by inflation, as rising prices erode the value of fixed interest payments. Inflation-resistant assets, such as real estate and commodities like gold, tend to perform better during high inflation periods. Diversification is a key strategy for protecting investments from the effects of inflation. By investing in a variety of asset classes, investors can spread their risk and potentially offset losses in one area with gains in another. Investing in inflation-resistant assets, such as real estate, commodities, and treasury inflation-protected securities, TIPS, can also help protect against the eroding effects of inflation on investments. Warren Buffett is a prime example of a successful investor who has navigated high inflation environments. During the inflationary period of the 1970s, Buffett invested heavily in companies with strong pricing power, such as Coca-Cola, which was able to pass on rising costs to consumers. He also invested in businesses with significant real assets, such as real estate and timberland, which helped protect against inflation. By focusing on companies with strong competitive advantages and a track record of generating consistent cash flows, Buffett was able to weather the inflationary storm and continue to grow his wealth. As individuals prepare for potential inflation, there are several practical steps they can take to protect their investments. One of the most important steps is to invest in inflation-resistant assets, such as gold, real estate, and stocks of companies that are likely to benefit from inflation. These assets have historically performed well during times of high inflation and can help preserve the value of an individual's investments. Additionally, individuals can reduce their debt as much as possible and live below their means. High inflation can make debt more expensive and decrease the purchasing power of an individual's income. Living below one's means can help build a strong financial foundation that can weather economic volatility. It's also important for individuals to maintain a long-term investment perspective and avoid short-term speculation. Trying to time the market during inflationary times can be particularly challenging, and it's often best to stay the course and focus on long-term investment goals. Warren Buffett has also offered advice on how to invest during inflationary times. He has suggested investing in productive assets that can generate cash flow, such as businesses and real estate. Additionally, he has emphasized the importance of avoiding investments that rely on inflationary trends to generate returns, such as high-risk bonds and speculative stocks. By taking these steps, individuals can better prepare for potential inflation and protect their investments. While it can be difficult to predict the future of the economy, taking proactive steps can help individuals weather economic volatility and build a strong financial future. In conclusion, this video has discussed the potential for high inflation in 2023 and the similarities between this period and the inflation experienced during World War II in 1943, according to Warren Buffett's warning. It has defined inflation and its contributing factors, while also exploring its effects on different types of investments. The video has highlighted strategies for protecting investments from inflation, such as diversification and investing in inflation-resistant assets, and practical steps that individuals can take to prepare for potential inflation. It is important for individuals to understand the potential risks of inflation and take proactive steps to protect their investments. By investing in assets that are more resistant to inflation and avoiding short-term speculation, individuals can mitigate the potential negative impacts of inflation on their portfolios. Additionally, maintaining a long-term investment perspective and living below one's means can be beneficial for financial stability during inflationary times. Overall, it is important for viewers to continue learning about economic trends and to make informed decisions based on their own research and analysis. By staying informed and proactive, individuals can make smart investment decisions that will help them navigate potential inflationary environments.